So sufficient diversification is widely accepted as one of the most important factors affecting an investor's performance over the long run. When it comes to mitigating risk, it's recommended that you disperse your capital among a number of different assets, classes, and even stock markets. And by doing so, it's told that you will severely be lowering your risk when markets turn south. But there is a big problem here. Some of the most successful investors, such as George Soros, William J. O'Neill, and Charlie Munger, have all discussed the benefits of having a much more concentrated portfolio. In essence, laughing off the claims that you need to diversify your portfolio. Warren Buffett has a famous quote saying diversification is protection against ignorance. So on the one hand, we are taught as investors to diversify as much as possible, but the greatest investors of all time seemingly are not diversifying. I mean, think about it. Do you have time to monitor the hundreds and hundreds of stocks you've diversified in your portfolio? I mean, most of you don't even have time to smash the like button, and as a gentle reminder, it's sort of just down there somewhere. I mean, it's just impossible for a regular investor who has an actual job to find time to check hundreds upon hundreds of financial reports day after day, let alone look for new investment opportunities. Now, there's a famous quote from Charlie Munger, Warren Buffett's right-hand man, saying that value investing is the only kind of wise investing. Their reasoning is maintaining a very small, concentrated portfolio that you can manage and you can consistently monitor on an hourly or daily basis makes perfect sense to them because they can operate in areas that they have physical expertise in. It seems that if they did have these 5 stocks in a list, they would only solely focus on the top one, maybe the second if it's screaming buy me too. The third, fourth, and fifth are just, well, they're not really that interesting. Why diversify in a company that could do good if there's a company there that can do great? Now that said, although it's possible to know everything about a small select set of topics, it's absolutely impossible to know everything about everything. And when the next bear market comes, if your portfolio is concentrated too thin, the market could humble you, especially if your sector is affected. An example of this would be if you're solely in oil companies during the COVID pandemic, your portfolio would be crushed. If you spread yourself too thin, your outcomes will suffer and you won't have as much chance of beating the market as you would if you were diversified, let alone the mental pain your portfolio will take. There's a lot of people here on YouTube and in the finance community preaching that individuals should only be investing into ETFs and index funds. And I kind of agree. If you do not care about beating the market and you're happy just to participate in receiving the average returns, then that's exactly what you should do. But despite all this offering you average gains, people seldomly go for it because it's boring and everybody dreams of buying a yacht, not just living the standard lifestyle. When I talk about this average investing and beating the market, I always think of Munger Pabrai. This up-and-coming legendary investing icon manages assets around $600 million US. That 80% of his portfolio is only in 10 different companies. The majority of his portfolio is also made up usually of companies that are out of favor, that analysts are saying do not buy or they fell on hard times. People are not interested in these stocks, so why is Pabrai buying them? And the simple answer is when Pabrai sees an opportunity he thinks is too hard to pass up on, he doesn't hesitate. He goes pretty much all in and puts his chips on the table. And the reality is these opportunities don't always come up. They don't show in the stock market. And once he buys them, it's just a waiting game and see what the outcome is. But the reason why he's so confident in doing this is if he's buying a company that he's very confident on, it means he's had so much time to go into the details of the business. An investor who has a smaller portfolio concentrated in just several stocks or investments needs to put in all the necessary effort to learn as much as they can about their holding and continue to research and see what's happening as days go by. They should be participating in every single earnings call of every single holding. They should be reviewing the financials and keeping a close eye on the business climate and the business's competitors. Benjamin Graham, probably one of the greatest investors of all time, who was actually Warren Buffett's mentor, is credited with saying, "The defining trait of an enterprising investor is his willingness to devote time and care to the selection of securities that are both sound and are more attractive than the average security." Buffett basically followed this advice and became the greatest investor of all time. An innovative investor of this kind may anticipate a good reward for his or her additional talent and effort in the shape of a higher average return than a return that is earned by a passive investor over the course of several decades. When people present the case that it's important to diversify, they will very correctly emphasize that by diversifying, your risk lowers substantially. When you invest in a diverse range of companies, you're basically lowering the risk that any one company going bankrupt can completely wipe out your portfolio, which of course nobody wants to happen. But however, it's worth noting that even if you were diversified into all companies, all sectors, you wouldn't be fully covered when the market does indeed fall. So diversification isn't actually a cure to guarantee returns in the future too. A big example of this is buying a number of companies in different sectors. For instance, you might purchase a technology company and then go and buy some consumer staple firms or maybe even some oil companies. This would allow you to sort of counterbalance your portfolio as these markets are cyclical, and as one goes down, another one may go up. But when the market as a whole is experiencing a decline because of inflation, a war, or raising interest rates like we are now, well, every sector is basically going to take a hit at some point. When macroeconomic conditions such as a bear market or recession lead the whole market into decline, you may limit some of the dangers that will come your way if you do have a few stocks to invest in by diversifying a portfolio. You might be able to weather a storm, or sell some tech stocks if you think they're overvalued to buy into consumer staples if you think they're cheap. Having a diversified portfolio will allow you to take advantage of this. But if you take advantage of that approach where you sort of start managing your portfolio selling, I don't know, like a tech stock to buy, I don't know, Walmart, eventually, if the market continues to go sideways or downwards, you're going to have a concentrated portfolio anyway, meaning you're not sticking to your diversification fundamentals in the first place. But somebody who has a more concentrated portfolio, a majority of them have cash lying around. They're not all in all stocks, like 5 stocks, 10 stocks, whatever it may be. They usually have a lot of cash sat around for when the next opportunity comes up. Legendary investor Bill Ackman believes that if you believe in a business and its prospects in the long run, you should continue to acquire additional shares, even if the firm's stock value and price goes higher. According to Ackman, if the stock goes up, you buy more. You are unconcerned with the size of the investment in relation to your portfolio. If you can figure it out, you can start construction. In 1974, when the market was experiencing a very similar bear market to what we're experiencing today with high levels of inflation, Warren Buffett was questioned by Forbes magazine about his emotions as the market falls down. And what he said, well, I don't think you could say it today. He said that I feel like an over-sexualized guy in a whorehouse. But it just comes to the point that when the market is falling, these investors who aren't diversifying like to bet big when that opportunity comes up. But to do so, it means you have to be willing to sit on cash. If you want to set it and forget it, then ETFs are definitely the way to go, and diversification, because you need to spend a lot of time researching and say a lot more no's than yeses. This is why if you have a financial advisor or a money manager, there's literal no chance they're going to put together a concentrated portfolio of stocks for you. Instead, they're going to offer you index funds or funds of funds instead, preaching diversification, when in reality, it just comes down to laziness and unwillingness to take unnecessary risk. I mean, trust me, I used to work in this industry. I know what people are pushing out. And because of this, if you want stellar returns that beat the market, you have to roll up your sleeves and be willing to put the work in. I want to restate this again. If you want to find success beating the market over the long term, you need to really go and do your homework. Learn as much as you possibly can about every small group of assets or individual company. That does not suggest go and put 80% of your wealth into Apple or Tesla or, God forbid, AMC. The halls of success we hear about are littered with legends like Warren Buffett and Benjamin Graham, but the floor is covered with the bodies of many of investors who have tried but have not successfully put the time, the effort, or the willingness to say no into their research. The icons we look up to, like Buffett, Graham, Munger, Pabrai, have all staked big percentages of their total investment portfolios on a very small number of companies and came out looking like sheer geniuses. But the halls of history, again, are chock full of thousands of average investors over the course of their financial careers have failed to beat even a basic, cheap ETF such as the VU. Too often it was because they were unable to manage risk or be real with their expectations. But the big one is the willingness to say no and sit in cash. Every financial instrument, stock, ETF, fund, is exposed to a unique set of risks to that individual asset. A portfolio of single concentrated stocks has a much greater chance to be sensitive to market volatile conditions, and your risk and your losses are definitely much greater than having a diversified portfolio. So that's probably left a lot of people saying, okay, I'm sold on the average, which is above average route. So how do you go about diversifying if you still want stocks rather than the ETF ETF route. The most important step in adding diversification to your portfolio, if you're picking individual stocks, is allocating the assets in an appropriate manner. This process will determine what kind of investments are kept in your portfolio and, more importantly, what percentage is allocated to each sector. Historically speaking, a diversified portfolio was the 60-40 split. We'd have a standard balance between bonds and stocks depending on where the market is. Your stock exposure could be diversified over a variety of market caps, industries, geographical areas, which is all recommended by financial experts out there. Investors don't only have to gamble on large cap firms such as Apple, they can hold mid cap and even small cap companies and still end up with decent results. But if you're wiping your brow, feeling overwhelmed, what do? I'm not diversified. I am diversified. I don't want to be diversified. Let me tell you, everybody watching this video should be buying ETFs. It's the closest thing you can do is set it and forget it and then sit back and let somebody else do the hard work for you. Currently, about 40 to 60% of my portfolio that's listed is in ETFs. Different sectors, different things. And I continue to buy into that every single month because I know over the long run, no matter what happens, it will recover. Each index fund or ETF you can find is comprised of a specific set of rules. They can buy certain stocks, bonds, whatever it may be. And there's ETFs out there tracking every single sector. So why waste your time checking an individual stock? There is a big probability that if you do diversify into ETFs, or sectored ETFs, should I say, that if one sector is going down, then another sector is going up. That's the way the market works. And that at its heart is diversification. You're just limiting the downside potential. But remember, you're limiting the upside too. And hey, if you want to ignore this advice and go invest all your assets into a business that's making cars purely powered on soy milk and optimism, just remember this financial advice. Your money isn't really gone when you lose it. It's just with somebody else. I find it really interesting overall that some of the greatest investors of all time do not diversify, but we're told to diversify. It's sort of a funny game the world is playing on us. But if you want to know more on how Warren Buffett and Charlie Munger invest, check this video out up here where I give some words of wisdom from the man himself. If you could drop down in the code word the word diversify, it would greatly help me out with the YouTube algorithm. Thanks for watching and good luck out there.